Hello everybody. So today I want to do a little bit of a different video focusing exclusively on small cap stock. And by small cap, I've put relevant stocks in there in my view that are both hyper growth, they grow very fast. They're both strategically relevant. I think they have a sound mega trend that they're operating in, and they're all under $5 billion market caps. And why would anybody want to invest in a small cap? Well, the whole theory of small caps is that it's more easy to get a multi-bagger in a small cap when you have a stock that's, say, less than $1 billion. Like I have multiple stocks here that are right at $1 billion or under $1 billion. The whole theory is that it's easier for a stock to go from $1 billion to 10 billion than it is for a stock to go from 10 billion to 100 billion. Now, I would argue in general that's not necessarily true because today stocks easily break the $1 trillion mark, and we have many of these, and we'll have many more of these in my view in the future. So that's not necessarily true, but nonetheless. Small cap stocks have a special appeal in the mind of a lot of investors and in the mind of money managers and retail investors, that yes, they can 10x, 20x more easily than other types of stocks. And that's why I want to cover them. So I have selected 8 of them. If you're new to the channel, really quickly, how to read this spreadsheet, because you're going to see numbers that you probably don't see anywhere else if you look at the spreadsheet. Just know that I'm a hyper growth investor. So the way that I look at stocks is very, very different from a lot of other channels. Like, for example, I don't look at PE. I don't care about PE. I don't even look at EBITDA or free cash flow. To me, all I know is that these companies, from what I see, they're not going bankrupt. That's all I care about. I care my companies not going bankrupt. That's the extent to which I care about earnings or proxy for earnings, because my style of investing is not about trying to get a return of capital. I'm not trying to get a return on my investment in the form of buybacks or dividends. No. I'm trying to invest in stocks whose products are getting adopted. In a nutshell, my strategy is that of the S-curve, that of the product adoption curve. So I tried to get into stocks whose products are just getting started, whose products and services adoption is just getting started. I try to get in early, and then I try to sell maybe 10, maybe 15 years after the adoption is done, after most people know the product. And typically what you find is that once stocks have gone through their adoption S-curve, once the product is widespread, once you see it everywhere, that's when stocks start to return capital, and that's when metrics like price to free cash flow, price to earnings start to matter. In my view, at the early stage, and most of these companies at the early stage, what matters is how much am I paying for that growth. So you can see all of these stocks I've selected based on the forward revenue growth. These are forward revenue growth numbers. You can see on average those 8 stocks have forward revenue growth of 51%. So that means that all of these stocks, if you equal weight them, all of these stocks will see 51% more adoption next year compared to this year, 51% more sales. So they grow very fast. These products and services are getting adopted, and that's what I invest in. And what I'm asking in this spreadsheet is, how much am I paying for each percentage point of growth? And that's this metric right there. Enterprise value over gross profit over revenue growth. That's a spin of the PEG ratio. That's a modification of the PEG ratio, where I use revenue growth instead of using earnings growth, where I use gross profit instead of using earnings, because most of these stocks are early, but they're early enough that they are optimized for gross profit. They're not just trading on potential total addressable market. No, they're still making gross profit. They're optimized for gross profit. So that's why I use gross profit. And I use enterprise value instead of market cap. Because if you look back in the early day, people used market caps because market caps were much easier to obtain, back in the 1980s. But today, of course, enterprise value is easy to obtain. So enterprise value is better because enterprise value neutralizes the effect of debt. It takes debt out of the equation. So that's why enterprise value is market cap plus net cash, and I think it's a better way to go. So now that I've presented the spreadsheet really briefly, let me show you the stocks in this spreadsheet. So a usual stock, if you follow the channel, is HIMS. HIMS is the king of undervaluation. I cannot explain why this stock is so cheap. This stock has kept raising guidance. It's now at 57% forward revenue growth over the next 12 months, 80% gross margin. The company is doing so well. The service and products that they sell are getting adopted. Their apps, both HIM's and hers apps, is consistently moving up in the ranking of the Android Play Store and of the App Store, the Apple App Store. So this is a company that's doing very, very well, and it's entirely dismissed and ignored by the market. HIMS is a company that aims to revolutionize healthcare by making healthcare digital. For what, 70 to 80% of the procedures, you can probably see a doctor digitally. So it makes making healthcare digital through an app. It's integrating the doctor with the pharmacy, so it's both an e-doctor or digital doctor and a digital pharmacy. And because it's all digital, it's cheap enough that it doesn't have to ask for your insurance. And in most cases, it is cheaper than using your insurance and paying your copays. That's why I think this company's value proposition is incredible. And that's why I think the product is getting adopted. I'm very happy to own HIMS. The next stock that I have that is pretty cheap, dirt cheap actually, is StoneCo. So StoneCo is, in a nutshell, it's the Square of Brazil. They have almost 3 million small businesses that have these payment terminals in Brazil. And they're the Square of Brazil, essentially. Brazilians love credit cards. They love to pay with credit cards. Small business need to adopt these different modern way of payments, and they have these StoneCo terminals, or they can use the StoneCo app. And StoneCo is the leader in the small business payment space in Brazil. Interesting company, interesting market that Brazil is. Brazil dropped interest rates, for example, which means that the economy, the velocity of money is going to increase in Brazil, right? Money is going to change hands more often. And of course, you're in the payments business, you're in the take rate business. So you want money to change hands as often as possible. And that's what's happening in Brazil. And this company, again, is dirt cheap. That forward growth of 40%, you're paying a 0.05 on that forward growth. So it is dirt cheap. I cannot explain why this company is so cheap. Both HIMS and StoneCo, I really can't explain why that company is so cheap. I mean those treasuries explain a little bit as to why the stocks are down, right? Because investors prefer put money into treasuries than they do in stocks. But they still don't explain why this is so cheap. Let me move on to LoveSac. LoveSac is a very small cap, my smallest cap actually out here. Stock entirely left for dead. I mean, if you look, it's trading at 0.69 times sales. So it's trading less than sales for a company that has a 53% gross margin, projected to grow at 22%. What does LoveSac do? They essentially do modern furniture. I mean, they do furniture for Gen Z and millennials. They're known for bean bags. It's the whole idea is the bean bag going to be more popular among millennials than the recliner. And they're also known for reconfigurable furniture. Doesn't really matter. What matters to me, however, is that valuation. That valuation makes no sense. It's 0.06. And even though that company is only growing at 22%, that valuation to me makes no sense. This is a stock that has been sold off, in my view, because the market is thinking, well, nobody's ever going to buy furniture again because there's nobody buying homes, right? Which are too extreme of a statements to be true. These statements are too extreme to be true. LoveSac is not going away in my view, and this is a company that has actually very productive stores, and they make a lot of sales out of their productive stores. And I don't understand why this company is trading so cheaply. I really don't. Then moving on to Xometry. So Xometry is a platform for prototyping for engineers. And it's a stock that I've just discovered recently, and those numbers caught my attention. When I look at the number of Xometry, I've been studying platforms lately on this channel, and I'm covering a little bit more platforms. I much prefer platforms, as I am slowly growing conviction, although it's conviction that I've had for a while, at least an intuition that I've had for a while, that platforms are the best business model out there. Platforms are better than as-a-service business models, because as-a-service business models, you get recurring revenue, and it's wonderful. You have recurring revenue. You don't have to fight for those sales every quarter, every year. You don't have to fight for the sales. platforms are even better. Platforms, you don't even have to make the product, right? It's your sellers who come to the platform who make the product for you. So to me, it's like the ultimate business. And when I look at Xometry, they seem to have a really nice niche in the engineering space, in the prototyping space for engineers. And the revenue growth for Xometry is 40% projected revenue growth. And it's actually, if you look at compared to the trailing 12 months revenue growth, it is accelerating. That growth is accelerating. And that gross margin at 38% is a little low for a platform. It's low in absolute, but this is a company that's just getting started. And we are getting this stock dirt cheap at a 0.14. So not him's cheap, but still extremely cheap for those metrics. And let me know in the comment section what you think of Xometry, if you think this is a stock that I should look more into or not. Now, moving on to a stock that I'm currently doing a deep dive on, that I will be publishing an analysis on, is Rover, rover.com. So if you're from Europe, you may not be as familiar with Europe and with Rover. And if you're not familiar with Europe, if you're from Europe, no, you're going to be familiar. And if you're from the US but you don't have pets, you may not be familiar with Rover either. Rover is a stock that I've discovered very recently, and it is a platform for pets where you can rent space for your pet to have accommodations when you go on vacations or on holidays. So, I mean, the quickest analogy is the Airbnb for pets. That's what Rover is. It's an Airbnb for pets. But when you look at those numbers, they are much more appealing than Airbnb, actually. For a platform with similar dynamics, with similar dynamics, similar patterns too, right? Because actually you wouldn't need Rover when you go on vacation. So this is a service that's mostly used when people go on vacation to look after pets, to look after your cats or dogs. For pet owners, when people go on vacation, they take care of the pets. So they have a similar market in my view to Airbnb, except only smaller, because not everybody has pets, of course. But if you look at the trend of pet adoption, it's absolutely insane. A lot of people have pets. Actually, in the US, it's more than 88 million people that have pets. And what's very interesting about this company is that not only the gross margin is excellent, when I look at this company, it's like, Airbnb has Vrbo and hotels, and you can make a case that Airbnb's Vrbo and hotels are much stronger competitors compared to the competitors that I can find for Rover. Like the next app that I can find competing against Rover is one order of magnitude smaller, and it's called WAG, and it's like one order of magnitude smaller. And so of course the market is so scattered. The legacy competition for quote unquote boarding or dog boarding is so scattered that I don't think they have a shot. I don't think they have a single shot. This is a company to me that comes as close to a blue ocean as possible, and it's a company that is still growing heavily in the United States and started going to Europe and started growing in Europe as well. And I think there's a huge avenue for growth. I was listening to their call, to the recent conference call, and the CEO was saying, Europe right now for us is like Rover was in 2013, i.e. it's a mostly unexplored market, and very, very fascinating how little adaptation needs to be done on that platform for that platform to go worldwide. It's mostly a US platform for now, but very little tweaking to the platform must be done, barely, like just translation, and then you can have this platform go worldwide like an Airbnb. And I find this company very interesting and very, very cheap given the potential. Definitely a company that has been flying under the radar and that I think Wall Street is not looking at. Now, moving on to a company that I've covered multiple times on the channel. I've done many videos on INDI, maybe less INDI than STEM, but INDI, I've done a few videos on INDI. INDI Semiconductors, they focus on providing electronics, advanced drive assist tools like radar, for example, as well as electronics for your car. For example, they have an Apple Car Key system, they have infotainment systems for cars, and they provide these semiconductors for these electronics to the legacy auto sector, to the competition of Tesla. So they're an enabler of competition against Tesla, which right there puts them in a little bit of a risky spot. I think we can all I'll see why. Because this is almost an edge, a little bit of an edge against Tesla. Nonetheless, why do I like INDI? INDI is in the semiconductor space, and pay close attention to this valuation. It's like, in the semiconductor space, stocks don't come that cheap. There's no such thing as stocks that are that cheap in the semiconductor space. And the only way I can explain this is this stock is flying under the radar. It is so cheap in my framework at a point 14, and the growth is stunning at 95% forward revenue over the next 12 months. So legacy automobile is rushing to adopt Tesla-like features, and that is benefiting STEM as a supplier of these semiconductors. And I think it's an interesting play, but it's a small play for me, obviously. All of these stocks, by the way, aside from HIMS and StoneCo, like HIMS and StoneCo are heavy positions for me. Heavy positions, but all of those other ones are well, some of them are not positioned, like Xometry or Rover are not positioned yet, but others are very tiny position. They're my, they're the way I satisfy that itch to trade, that itch to touch stocks, right? The itch to own stocks. That's how I live my passion, by owning small stocks like this, So you got to be very careful with allocation, though I am very careful with my allocation on those stocks. Nonetheless, I find them interesting, and it doesn't remove anything from them. They are very interesting companies in my view. STEM. What is STEM? STEM is an installer of megapacks. They install the Chinese megapacks as well as the Tesla megapacks. It's a bet on energy. It's a bet on the future energy, on the going away of peaker plants. That's one of the big advantages of these battery packs. They eliminate the need for peaker plants in many cases, and they help enable a lot of the transition to electric. Without mega packs, for example, you can't have semi truck charging, as an example. They help utilities manage. It's a mega trend. It's a definite mega trend. And STEM is an interesting company in the sense that they're growing very fast as an installer of these mega packs, because most of their revenue right now comes from engineering these systems. But once they engineer and install one of these systems, they get a 20-year contract with Athena. And that contract for their software, called Athena, has 80% gross margin. So this is a company who over time should see less revenue coming from hardware install and hardware sales, and more revenue coming from revenue and the revenue contracts that they sign, as well as the maintenance contracts that they sign. This is a company living at the heart of a mega trend. Also a company living in the shadow of Tesla, just like INDI, but dirt cheap, and then essentially left for dead. I don't understand why this stock is this cheap either, especially, when I run so many mainstream stocks on this spreadsheet, they have awful valuation. Absolutely awful. It's all, when I read it from my spreadsheet, it's all red. It's like bleeding red out here. Like, these stocks are dirt cheap. I'm not sure if the market is catching on. One day it will. As interest rates drop, I believe this is the type of stock that will greatly benefit as interest rates drop and people start opening their eyes to those opportunities of these stocks that are not yet gap profitable, but still have enough cash on the balance sheet or enough cash flow to have a longer runway ahead of them, right? These stocks are not going bankrupt. No investment advice, but in my view, they're not going bankrupt. When you look at the income statement, when you look at the balance sheet of these companies, they're fine. Moving on to Sunpower, finishing up with Sunpower. Sunpower is interesting play in solar. It's a holistic play in solar. I put it in there because it's my cheapest solar stock out of all of the solar stocks that I follow. It's the cheapest, and it's the main small cap, right? Because I'm big on Enphase on this channel, but Enphase is not a small cap. Does not qualify as a small cap. Very interesting. Sunpower. They have a specific positioning on new builds. They do a lot of installs for new builders. That might explain why the stock is down so much. But what they do is they have a fully holistic system for home solar. So they have their own app, their own battery, and they use N-phases microinverters. They use N-phases microinverters, which makes me bullish about this company because they have the right technology, i.e. N-phases technology, and then they just add their own systems, their own sourced solar panels. They source their own solar panels. They do everything. They're an interesting company in my view. Smaller cap, smaller play. The cheapest stock out of these 8 stocks, but a little more expensive than the other one, but still pretty cheap at a 0.24. And if you summarize everything, we get the average enterprise value of these 8 stocks is 1.4 billion, revenue growth 51%, gross margin 52%, and it's dirt cheap. They are all very undervalued in my view, but word of caution, position sizing is extremely important. Don't ever forget, as I always say on this channel, 30% of my portfolio is in Tesla. And I don't cover Tesla on the channel because everybody else covers Tesla. So that's why I don't cover Tesla. But position sizing is so important, and I fundamentally believe that position should be sized based on the risk of the stock. And small caps are obviously riskier. All it could take is somebody taking a short position, right? A short seller takes a very large short position on any of these stocks and then releases a short report, and then boom, one of these stocks can drop 30-40%, as it's happened many times. So these are riskier stocks, which is why I believe in proper allocation sizing. Anyways, this was not investment advice. This is just entertainment. I hope you were entertained, right? Not investment advice. I appreciate all of your likes. I appreciate you subscribing to my channel. I'm very grateful for all of the time you spend watching my videos. And please follow me on X. I am active on X. It's the only social media that I have. Thank you, and have a great day.